Attention property investors. Your friends at the Australian Tax Office might be taking a closer look at you and your tax return this year. In fact, a closer look than you may feel comfortable about. Just recently, Assistant Tax Commissioner Gavin Siebert said the Tax Office has made property rental deductions a top priority this year, explaining that a random sample they took of rental deductions from property investors, they found 9 out of 10 tax returns contained an error. And they were concerned about the compliance, and they saw that this is a possible way of them being able to get significant extra revenue. So, what can you do not to get yourself into trouble with the tax man? What's the tax man looking for at the moment? How can you prepare yourself if you do get an audit? They're the things we're going to chat today about with Australia's leading tax strategist, Ken Race, Director of Metropole Wealth Advisory. Welcome, Ken.
Hi, Michael.
Now, Ken, we were having a bit of a chat about this, and you told me the number of property investors that put in tax returns and the size, and it was quite significant of the tax benefits they were claiming. So you can see why the tax man's looking at them. What sort of amount are we talking about?
Yeah, there's almost 2.2 million property investors putting in tax returns, but the big number is the expenses they claim. There's just over 47 billion, with a B, $47 billion worth of expenses. So the tax man, in my view, is seeing this as potentially low-hanging fruit, that if they can get even 5% more deductions refused, that puts a lot more money into the coffers of the budget. So with 9 out of 10 making errors, they're hoping for a substantial review of incorrect tax returns to claw back some of this $47 billion.
Well, I've read, Ken, that the tax department spent a lot of money on computers and data systems, which means that they're looking at us. I guess that's artificial intelligence, isn't it? And then they're also cross-matching with other databases, Ken.
Correct. Certainly over the last 5 years, there's been a lot of money spent on IT and human resources at the tax office. And what they're doing now, and we're seeing it as a normal taxpayer, your tax returns are pre-populated with things like dividend, interest, lots of other expenses. But they're now going even further to state governments and tying in land records to see who's got property, when did they buy it, are they registered for land tax. So there's more and more information coming in. And now the computers, through artificial intelligence, as you're saying, are just sending out letters to taxpayers based on certain criteria. So what is the average dollars that people spend on repairs, or what is the average dollars that people are spending on council fees, or any number of line items, because they look at it line item by line item. And if you're out of, can I say, the average, the computer just sends you out a letter, please explain. And then for many taxpayers, that's what starts the whole journey on getting into an ATO audit.
Well, clearly the tax department does allow many significant deductions for property investors and other people who run a business. So it's important to get them right. But there are some grey areas. So I'd like to go through the common ones, the common mistakes investors are making to make sure that we don't do that. Now, one of the ones that's always been a bit of an issue is repairs versus maintenance. In other words, is it a repair, or am I improving my property and therefore adding value? So can I claim it all at once, or is it something I've got to write over time, Ken?
Yeah, that's a big one, repairs and maintenance versus improvements. And the difference that makes for a property investor is, if it is an expense, a repair and maintenance, it's claimed in the year that you spent it, versus an improvement, which might take you up to 25 years to get back, depending on where that money is. Typical areas that I think people make errors on is in the kitchen. Am I replacing kitchen cupboards, one, or have I replaced all the kitchen cupboards? So if it's all the kitchen cupboards, then it's an improvement that would be depreciated. Things like gutterings, have I replaced a small section of the gutter or have I replaced all the guttering on the roof, which would be an improvement. Lots of areas like that are typical of what the ATO are looking at.
I know another one they're looking at is, are you doing some improvements or what you may want to consider repairs when you purchase the property? That's not really allowed as a repair, is it, Ken?
Correct. So the timing of the expenditure is critical. If you buy a property and before you put that first tenant in there, you go and do some repairs, some maybe paintings, repair some worn out carpets, the ATO says for tax purposes, that's an improvement because the purchase price was probably lower than it would have otherwise been to pay for those things. If it's an expense during the tenancy, like I've replaced the carpet in one bedroom, that would be repairs and maintenance. But if you repair by replacing the carpet in one bedroom prior to the first tenant, that's an improvement which would then have to be depreciated. So that makes a huge difference.
Ken, at the beginning you mentioned that there were $47 billion worth of deductions that property investors are claiming each year. I assume a large proportion of that would be interest expenses, but some interest is deductible. And I know occasionally investment loans get tainted with private issues as well. And the taxman is looking at that a bit more carefully.
Yes, interest deduction is a very significant part of the 47 billion. And there's a large number of property investors who actually don't have an interest deduction. But focusing on those that do, the most critical thing is to look at the purpose of the loan. Did you borrow the money for an investment purpose? If the answer is yes, then it's deductible. That's even the case if you drew money out of the equity of your home. The purpose of the loan is investment. So you've got to be very careful then on two things: how you've used it and the name on the loan versus the name on the ownership of the property. So if we take the second one, a lot of people draw money out of their equity from their home, which could be in two people's names, but then apply it for the interest deduction on the property that's in one spouse's name. So the ATO says, hang on, you've got a loan in two people's names. You can't claim it all if the ownership of the investment property is in one name. You've got to put in place other paperwork to actually make 100% of that loan deductible to the person on title.
Ken, I assume it would be much the same if you bought the property in a company trust structure where the ownership name is different to where you release the equity from your home, which would be in your personal name.
Correct. And some people use trusts where they can actually push down the negative gearing to that wage earner, even though they're using a trust. In that scenario, the bank may make the loan to the trust, but we want it in the individual's name. So that's another classic thing that can be corrected if you go to a property tax specialist to help you put in place the right paperwork.
Now, I know the taxman is particularly looking at errors where you're incorrectly claiming interest that wasn't tax deductible, Ken, that wasn't used to produce income. What are they pointing there?
Yeah, typically that happens if someone takes down a loan that they, can I say, taint with a little bit of investment and a little bit of personal. So they could draw down equity from their home loan, where they apply part of it to pay for deposits, purchase costs, and part of it maybe for a renovation on their home or a holiday. In that scenario, the ATO says, well, what was the purpose of the loan? You either have to go through and do very detailed, can I say, Excel spreadsheets? And when you're looking at interest being charged on a daily basis, they can be very complicated. So a simple solution is to actually split that loan. So get the bank to give you two loans. One that'll be for the investment, one that'll be for personal. You get two statements, and then it's very easy to show which loan was used for investments and therefore 100% deductible with minimal admin.
Another issue seems to be where people are depositing some funds, some surplus money they've got, and they're not sure where to put it. And if they put it in a loan that's used for their investment properties, and then later out they take some money out again because they're putting it there because they don't want to pay that much interest, but then they take it out again, they're using it for personal expenses. It gets very messy, Ken.
Very messy, and can I say quite disastrous to the amount of money you can claim. Depending on which loan strategy your property broker has put in place, typically they're called either an offset account or a redraw. The bank normally gives people a redraw facility. I'm not a loan broker, so please don't take this as loan advice. But if you've got a redraw facility against your investment property, as you put money in, it reduces the debt and therefore the interest. And then when you pull the money out, the ATO says, what did you use that for? If you used it for personal reasons, you have automatically reduced the deductible debt forever. And imagine if you put $10,000 in every month over 12 months to put it in, to take it out, that would reduce your deductible debt by $120,000. But if you had set up what's called an offset account, and again, talk to your broker because different banks call it different things, it's a separate loan bank account where you deposit the money in and the bank automatically adds them together and then charges you the interest on the net amount. And then when you pull the money out of that offset account, then the original loan is still in place. That makes a huge difference to people. And can I say, that's one of the errors I see very, very frequently.
Well, in our book, What Every Property Investor Needs to Know About Finance, Tax and the Law, there's 2 chapters on this. So again, while neither of us are registered mortgage brokers, finance brokers, what we do know is the big principles, and we've explained that. So I agree with you that the idea is to put all your excess cash flow and often the rent into your offset account, but it's really important to document everything very carefully, keep thorough records. And I think one of the things you brought up a moment ago, some people don't understand the concept of split loans. So even though you've got a home mortgage, you can actually split it into 2 separate loans. So one is paying off the mortgage, the home that you started with, and the other loan is used for a different purpose, for example, for investment purposes. So the banks are quite comfortable splitting loans over the same asset. Now, Ken, as we're working through the things that the tax department is looking at very carefully, I notice one of the areas that they're concerned about is capital gains tax. When is it applicable? Are you able to get the deduction, the 50% general discount for it, or shouldn't you? And this often happens when you sell a property. You may have gone in initially with the intention of renovating it, improving it and selling it, or maybe your circumstances changed along the way and you really did intend to hold it in the long term, but circumstances changed and you had to sell. Very different scenarios, Ken.
Very different tax outcomes as well. It all boils down to what was your intention at the time of purchase. So if your intention was to buy it and hold it as an investment, then that's seen as a capital item. And if you sell it, it's capital, and you get the 50% capital gains tax discount if you had held that property for more than 12 months. Now, be very careful with that. It is 12 months, which is the legislative time frame. But if you sell it 12 months and 1 day, you will probably get a please explain from the ATO. Did you purposely keep it for tax avoidance reasons, that extra little bit? Make sure you document your reasons of the timing of the sale and your intention. If you bought it with the intention to sell, then it doesn't matter how long you've kept it for. You could keep it for 5 years. And if you sell it at that time, then it's just normal tax. You just pay tax at your marginal tax rate, which is the tax rate that you pay on that extra dollar that you earn. Irrespective of the time that you've held the property, normal tax if your intention is to sell when you originally bought it.
Now, there's another thing that people don't recognise with capital gains tax. Often you've owned a property for a number of years, you've claimed depreciation, and maybe over the last 10 years, you've claimed $50,000 in various depreciation allowances. When you sell the property, Ken, you've actually got to put that back in, don't you?
Yes, there's two depreciation items you can claim. The capital works, which is on the building. So for most people with a recent purchase, that's the 2.5% depreciation. That means the building is depreciated over 40 years, or the fixtures and fittings, carpet, Venetian blinds, the hot water system. That then is depreciable over a much shorter period of time. Now, when you sell, the ATO normally accepts that you've sold the fixtures and fittings at the written down value, but for the capital works, they want you to add that back into the calculation, which effectively reduces the cost that you've bought the property for. And by reducing the costs, it means the capital gain is higher. A lot of people complain, well, why should I claim depreciation on the building if I have to pay it back? Well, two reasons. You don't know that you're going to sell. And secondly, when you're claiming it, you're getting it back at your full marginal tax rate. And then when you give it back, you get a 50% discount. I'd rather have the money in my pocket. And if I have to give it back, well, I only give half of it back, if I can put it that way.
Now, there's also issues if you've been living overseas for a while with capital gains tax, Ken.
Yes, the 50% discount really applies to Australian tax residents, if I can colloquially put it that way. If you've had a period of overseas engagement, then you lose the 50% discount proportionately to the time you're overseas to the time you've owned the property. Again, get a good property tax specialist to help you go through that. Now, although we're talking investment properties, let me just add this extra point. If you're a homeowner, so it's your home, if you sell that while you're living overseas, you actually lose all the main residence exemption. That's quite a significant bear trap for people living overseas selling their home.
This is another reason why people need to see an accountant who specializes in property. These little traps aren't always well known. There are more issues with overseas residents, foreign residents, trusts that have foreign beneficiaries. Haven't got time to go into these here, but I know that that's what you and your team at Metropole Wealth Advisory specialise in, advising people how to structure themselves properly, and also not getting caught in the trap of having to pay a bit of capital gains tax on your home, even if you're not overseas, because you've done certain things along the way, Ken.
Yes, a lot of people end up living in a home that was an investment property or vice versa. If you have a look at what the capital gains tax methodology is, there's two different methods to calculate the capital gain. If you lived in the property first and then turned it into an investment, versus I had a tenant for a period of time and then moved into the property. So two completely different methods that give you two totally different tax outcomes. And where sometimes people are trapped is if they buy a property that's got a tenant in there, then that period of tenancy will be taken into account to say you didn't move into it as soon as practicable, because the ATO doesn't care that there was a tenant with a lease, and therefore that property will have some portion of it taxable if you ever sell it. Completely different methods. Find out where and what method you would be looking at to help you decide on how much money I'm going to have left over after the sale.
Now, I know another area the taxman is looking at carefully, Ken, is personal expenses, expenses that you could be claiming as investment related when it's actually personal. One of those, of course, is holiday homes. That's always an interesting thing. How much of the holiday home can I claim as an investment, especially if I let it out to friends or family at a cheaper rent, especially if I don't let it out at peak holiday periods when I go myself? What are they looking for there, Ken?
They're looking for, was that property available for rent? If you're going to use it half the year or not put it on the market, or can I say a nod and a wink with the real estate agent, not to actively look for a tenant during the summer periods, then you will lose the deduction on those expenses proportionately to the time that it's not available for rent. People try and gild the lily, if I can put it that way, and try and claim more costs than they're actually legally entitled to. The other big area that you've got to be very careful with holiday homes is obviously because you're living in the property as an investment, because you've still got your home, it's still subject to land tax. You won't get the full land tax deduction depending on how you're using that property. Fully taxable, as if it was an investment property for 100% of the time, proportionately on how you're using it. But there is a part of the Tax Act that says for personal use assets, such as a holiday home, you can actually accumulate the expenses that you didn't claim as a deduction to increase the cost of that property. So when you sell it, if you sell it, you've got a higher cost, which reduces the taxable gain. I tell all my clients, keep records of expenses on that holiday home, even if you're using it 100% of the time, let alone a portion of the time. The other big one is Airbnb. People think if I rent out part of my home as a bedroom, then it's not income that I have to declare. It absolutely is. It's income you have to declare, and proportionately on the home, you'll lose part of the main residence exemption. And depending on the percentage you rent out, you actually could find a land tax liability as well.
Interesting. So lots of things to watch out for. I guess what you've got to do is document things carefully. This has come up over and over again. Keep receipts, because it's on the onus of the taxpayer to prove that a deduction is legitimate. And I know that the taxman looks for those receipts as the simple way of doing things. I know that I have actually been audited on 2 occasions, and fortunately, because I have worked with you for so long, have not had any problems at all. It actually hasn't surprised me that I've been audited, considering the large amount of claims you have helped me be able to legitimately claim. So, but what are the penalties? What does the tax department do if it finds you've made a mistake?
I think, first of all, don't panic if you get a please explain, because the ATO has now increased the number of people that they're going to spot check. Don't panic. Go and make sure your accountant understands it. And if you've registered with a tax agent, that letter goes to the tax accountant, who will then advise you. The penalties for, making an error vary depending on whether the ATO believe it was just a mistake that you inadvertently made versus a conscious error to defraud the taxman. The penalties will range, roughly 25 to 75%. It can be as high as 95%, plus interest. The more likely you are to get a lower penalty is if it was just an inadvertent mistake that just happened, and as soon as you get the please explain, you find out you've made the error and get straight back to the ATO saying, look, I think I've made a mistake here, and this is what I should have claimed, and therefore this is the situation. That is, you've come clean. Even though you've received please explain, the ATO treat it as you've come clean, and therefore much less penalties.
Of course, you shouldn't handle this yourself. You should get your property tax accountant to represent you. They will be able to be a bit of a buffer in between, because you get quite emotional when this happens. It is scary. But the other thing is you can insure yourself against these issues by taking out tax audit insurance, which I have done. And I know almost every accountant would recommend that to their clients. And this helps you with accountancy fees and legal fees if you're audited. But Ken, it doesn't cover you for penalties or mistakes, does it?
Certainly, and certainly not the emotion. And those fees that are covered, whether it's from the ATO at a federal level, or normally also from a state level, such as land tax or a stamp duty query. It's a tax irrespective of the jurisdiction. Particularly if you've also got self-managed super funds, if you've got a property in the self-managed super fund with debt, you're sort of raising the number of red flags that you possibly could get. Talk to your accountant to look at audit insurance, which is fully deductible as well as an expense.
So the tax man is after you, but they don't even know who you are. You're just a number. Don't be scared by it, but prepare yourself by putting your house in order before you start. One way of doing it is, I know at Metropole Property Management, what we recommend to all our clients is that they should allow us to pay all their bills and all their expenses related to the property, which means that at the end of the year, and I know Bronwyn, our trust accountant, who's been with us now for 13 years, on the 1st of July, as soon as the financial year is over, she gets you out a statement with everything, all the income, all the expenses, all the receipts, which means you hand your accountant one set of documents. You don't even hand it to them anymore. You don't go in a shoebox, do you, Ken? You actually email it to them. I guess you were around years ago when people used to, at the end of the financial year, come with their shoeboxes.
That's it.
Another way is to get the right people on your side before you start. And that's where I'm recommending you have a chat with Ken Race, who's clearly regarded as Australia's leading property tax strategist. At Metropole Wealth Advisory, he and his team can review your structures, can make recommendations, find ways that you can implement any changes if they're required. So if you're looking for independent advice, now Ken's not, he's an accountant. He's not going to do your tax. He's going to be the specialist who's going to help you set things up, and then your own accountant is the one who's going to be doing the day-to-day work and the compliance work. But imagine the benefits having this new level of support, this new level of guidance, this raised level of insight into the critical drivers of your wealth. It could possibly help you minimize your tax. If you do that and stop the leakage, it would help you build your wealth. It's definitely going to manage your risk. And I guess the aim at Metropole is for you to grow, protect and pass on your wealth. So setting things up correctly and setting up the right estate planning documents would also help you pass on your legacy. So go to metropolewealthadvisory.com.au or just simply metropole.com.au and click on the Wealth Advisory link. And why not have a chat with Ken Race, Australia's leading property tax strategist? Thank you so much for your time, Ken.
Thank you, Michael.